Hello and welcome to this week's On the Spot. I'm here with John Paul Hampstead as always, and I'm Zach Strickland. Good day, John Paul. So this week we had a lot going on. We had a lot of earnings. Yep. Did the freight market bottom? We're not really sure, but it does appear to be at least horizontal for the moment. But let's kick things off. Let's talk about what we've seen in the freight market this week. JP, what have you heard? What have you seen?
Yeah, I mean, I don't know if we found a bottom or we're at the floor, but we certainly found a floor, right?
Right.
So OTVI has been in between basically 8,400 and 8,700 for a solid week now, if not a little bit longer. So that kind of implies that the things that are going to be shut down have shut down. Whether it's retail, whether it's goods being delivered to places like restaurants and hotels and various inessential services that are shut down. Although, as we've noted before, there's been quite a liberal definition of what's essential and what isn't.
Right.
Including, in Florida, apparently WWE is essential, which hasn't been shut down. So that being said, volumes are still, quite low, but appear to have stabilized for now. OTV or OTRI, our measure of relative capacity, the percentage of contracted loads that are being rejected by transportation providers, dipped below 3%, which is very low indeed. I think it's like 2.87%.
Close to 2.8, yeah.
Something like that. So that's alarming, and that's going to continue to pull rates down. If you look at the DAT number, which is on a slight lag, that's going to be around $1.21 a mile for nationwide average. Of course, we've seen widespread reports and complaints of rates below $1 a mile, and
of course is at a loss in most cases.
Oh yeah, definitely. And that's problematic, and it gets to kind of the next thing I want to talk about, which is how destructive the current business environment is for capacity. We talked about this all through 2019 as we saw new truck orders crash. We saw very low rates, anemic volumes for most of that year, and the mantra we heard over and over again from publicly traded trucking companies was that capacity is leaving the market, good times are on the horizon, et cetera. And so like I said, we measure relative capacity through tender rejections, but it's really hard to measure absolute capacity or the number of trucks available for dispatch. So one of the ways we do that is by looking at the number of Landstar BCOs, business capacity owners, they're leased on owner-operators. And the Landstar reported earnings on Wednesday, so we had a chance to update our model. And what we do is, the theory is that when rates are good, when the business environment is favorable for carriers, more people become truck drivers, and more company drivers become owner-operators, which is, if you think about it, is sort of the risky, leveraged end of the trucking business. You're exposed to lease payments and insurance, et cetera, but if you're really confident that you can make a lot of money, you might go out on your own. And so we look at specifically the quarter-on-quarter change in the number of Landstar BCOs. It doesn't really do to look at the absolute number or the total number because it's grown just over time pretty steadily.
By general attrition.
So you want to look at the direction that's going. Is it compared to the previous quarter? Are there more or fewer BCOs? And the number of BCOs went down again in the first quarter of 2020. It's the first stretch in our data, which goes back more than 10 years of a decline for 4 quarters straight. And in fact, this is also this current downturn we're in is also the first time it's gone down 3 quarters straight.
Now, this is an interesting topic to me specifically, because you just said this is now the fourth quarter straight that we've seen the decline.
It started in Q1 2019 after the spot market initially crashed after 2018.
Right. So this isn't necessarily like all coronavirus.
No.
We were already in this kind of downward trajectory in terms of capacity coming offline. We saw a lot of these earnings calls. Most of the carriers that I read about all reduced their truck count, at least in their for-hire units.
Yeah, and just remember in 2019, trucking companies were going bankrupt at about 4 times the rate the year prior. So this is a continuation and acceleration of that story of capacity leaving the market, which I just think is really interesting, because when OTVI is below 9,000, we're not necessarily going to see the other shoe drop, right? We're not going to see, there's still plenty of trucks, right? We're not going to see capacity tighten, but at some point, I don't know if it's going to be in the third quarter, I don't know if it's going to be in the fourth quarter, when hopefully not later than that, but when economic growth returns to what we consider normal level, 2% or above, it will be really interesting to see what happens to rates and how much, if shippers and brokers are exposed by the lack of capacity in the market.
Yeah, so that point of inflection that we watched happen this past March with the OTVI, how far up did it have to go to see a significant increase in tender rejection rates? It was around 10,400. That level seemed to create more of an acceleration in tender rejections, therefore spot rate increases, et cetera. Prior to that, in 2018, it only had to go up to around 10,100. So there was an implied increase in capacity, tender acceptance, et cetera, that came along with, improved, truck utilization, et cetera. All of these things came together throughout 2018, improving supply conditions, et cetera. And now we don't know how deep this trough is going to go, how long it's going to extend, and through that, when we come out on the other side, will that point of inflection be around 9,800 on the OTVI?
Yeah.
That's kind of the big question, is we obviously had capacity able to absorb a pretty decent amount higher than that at 2018, level. So we don't know exactly what that's going to do on the other end of this. I mean, the PPP the program, the government small loans for the payroll protection, will probably keep some people online that wouldn't make it otherwise. So we don't know what that's going to do to capacity on, say September, August. Maybe it's the exact same, maybe not. We don't know.
And keep in mind that the PPP may keep people on the payroll. Doesn't necessarily mean their trucks are rolling. Right. Like every carrier still has to decide whether they're going to run their trucks at a loss or not. Right. Right. So that's if the rate isn't covering the rate isn't covering the operating costs, but you've got like the wages paid for, but you still have to worry about fuel, insurance, maintenance, etc. So that's a calculation that also has to be made. Zach, can we talk about places in the national freight market where it looks like volumes, maybe coming up a little bit off the bottom? Any green shoots out there?
So we were talking about this earlier. We're seeing, since we are seeing our national outbound tender volume index sort of hit a floor for the moment, not necessarily making a big jump or anything like that, but there are some markets out there right now that are showing at least mention-worthy increases in volumes, the Ontario market being one of those. Ontario, of course, is out there on the West Coast next to Los Angeles. Huge DC environment, a lot of freight comes in off the ports, gets transloaded into those warehouses, and then a lot of that long-haul freight moves across the country, replenishing a lot of the warehouse freight on the East Coast and Midwest, et cetera. So that's a pretty notable increase. Something that Mike Vinton and I talked about the other day with Greg Miller is the fact that a lot of that volume may be kind of a false signal. A lot of this freight coming in may be replenishment, but they were orders placed prior to a lot of the demand side shutdown.
For sure, definitely. But there are places like Atlanta, Laredo, McAllen, even Seattle, scattered markets in the Midwest, Terre Haute, places like that, where we're seeing positive week over week growth in volumes. It's not just the port cities.
No. It's not just the port cities, but they are some of the most, significant. Obviously, Ontario, the second biggest market in the country, but Elizabeth, New Jersey, has had a pretty notable increase. Atlanta has shown it's popped its head above water for the first time. Again, these aren't giant increases, and this is kind of what we are expecting to see. When things start to turn back on, this kind of fragmented recovery. It's not necessarily about things shooting up super fast like we saw in March, but it's going to be like a 3% increase here in Atlanta, a 2% increase in Detroit, et cetera. And the Detroit market, of course, very interesting to watch.
Yeah, and that's one we're keeping a closer eye on because the big three want to reopen the production facilities on May 4th. But the United Auto Workers, the union, is saying that that's too risky because of coronavirus concerns and outbreaks at their plants. So we have seen an uptick in Detroit for, outbound tender volumes sort of in anticipation of this or in advance of this. A slight uptick, right? Let's just say it's not going down. It went up, not by a lot. Clearly, in the next week and a half, if they're reopening production, we expect that number to go up by a lot.
Tremendous amount.
And that's going to be really interesting because we're going to be able to watch the reopening of the American auto industry literally on a day-by-day basis and see exactly if the suppliers are ready, if the assembly plants are ready, and really how much freight volume comes back online and how fast it does.
Yeah, the Detroit market, of course, had their shutdown already. We've already seen this happen earlier in the 12-month cycle here in September when they had their strike. Yeah. A lot of those plants shut down up there, but it's not just about Detroit. It's about all their satellite areas as well, all those feeder plants, if you will, that manufacture all these products for the assembly and whatnot.
Yeah, and honestly, there's a whole auto belt really that kind of goes from through the Midwest of the country, essentially from Michigan and Ohio, and even Ontario, if you want to talk about like Windsor, Canada.
And also Mexican.
And it goes all the way down through Mississippi into Mexico. Really, like there are plants all dotted all through the Midwest.
Yeah, suppliers have this big supply chain kind of line coming up from Mexico all the way to into Canada.
There's a big Toyota plant in Kentucky that wants to reopen on May 2nd. Mm-hmm. We'll see how that goes. Obviously, plans throughout the Southeast. I just think there's going to be a really important negotiation between labor and capital, between the health concerns and the economic concerns. I think that's going to be really interesting to see play out. And of course, we'll know whatever the government is saying, the union is saying, the corporations are saying, we're actually going to see what freight is moving.
Yeah, and the automotive sector, of course, indicative of that industrial segment that we're closely watching to see if that recovers. So, we had a slew of earnings reports come out.
Oh yeah,
real quickly. Right. Let's go through a few of those because I think there's some stuff to glean from these moving forward and what to look for, in the rest of the year. So we had Knight-Swift come out. Yep. Landstar, as you mentioned, Heartland, and Echo Global, a big brokerage. They all reported year over year kind of increases in revenue, at least, not necessarily in margins, but in revenue.
They had a really tough Q1 2019. It's a weak comparison, just to keep that in perspective.
Right.
But yeah, they grew revenue. I covered Echo specifically. They talked about a little bit of margin compression, actually 204 basis points of margin compression year over year, which makes sense if you think about collapsing spot rates in the first quarter of 2019, and then you think about that huge surge we saw in March of 2020, which is going to imply a surge in the cost to a brokerage to book trucks. So it makes sense that you'd see year-over-year margin compression. They did say that blew back out to about 17.3%. The first, I think they reported the first 13 business days of April, so whatever that adds up to. It came back, widened back out by about 100 basis points. Although I think one of the important numbers for a couple of important April numbers that Echo provided updates on, which I thought were really interesting. One, revenue per day down 12% in April, year over year. Two, LTL volumes down 24%.
Way down.
So that's going to be related to the shutdowns of small and medium-sized businesses. I think they said the truckload volumes were only down about 4%.
Right.
So and that's also going to, Dave Menzel, the Chief Operating Officer of Echo, did a really good job explaining the impact to their gross margins based on the mix shift. So LTL tends to have wider margins for Echo.
Yep.
So as their portfolio of revenue shifts toward truckload, because LTL volumes are so far down, that's going to make, what could have been a very wide gross margin, it'll be a little bit narrower.
Yeah.
So that's something to keep in mind.
Yeah, so
I thought it's really interesting stuff.
Yeah, and again, a lot, the big thing that I took away from this is that we have not seen the full brunt of the coronavirus impact to the freight market or trucking in general. A lot of these guys did not necessarily have that bad of a first quarter, but they were talking about, not giving guidance for the rest of the year just because of all the unknowns and uncertainty. So one thing's for sure, it's going to be a wild ride for the rest of the year, more than likely.
Definitely.
Hopefully a lot smoother than that. Well, that'll do it for this week's On the Spot. Be sure to check out FreightWaves.com for any future freight updates and all the intel you need. Have a great weekend.